Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I threw together some charts that I was looking at Twitter. Very good charts. I pretty glad I found them. Wanted to share them with everybody, and we'll jump in here and I'll share them. The first one on the upper left here is the S&P 500 and the U.S. High Yield OAS, the option adjusted spread. So the U.S. corporate high yield average option adjusted spread is in the red, and then the blue is the S&P 500. And just by looking at how these kind of correlate, you can see that we are coming up into the OAS, the high yield OAS is breaking this long-term sideways pattern resistance line to the upside. It says a breakout for the U.S. high yield OAS is a bearish leading indicator for the SPX. This is the bottom for the U.S. high yield OAS. You can see the nice good bottom here. Conversely, on the making a shoulder head shoulder or shoulder head shoulder top and a potential move to the downside is the S&P 500. So these correlate very well and they move in the opposite directions. In 2019, we had this move going up in the Bloomberg U.S. corporate high yield average OAS, and you can see the nice, good, solid move lower in the S&P. So I think S&P 500 is lower. This will be higher, and yes, commodities are still a great spot to be. I was looking at some housing data, and someone had put this in there. There was like a battle between a bunch of people. They think interest rates rising is going to crash the housing market. There's a lot of us that don't think it is, and there's some people that do think that it's going to crash. One of the people posted this, says total U.S. population by age and generation. The baby boomers are 68.7 million. The millennials that are coming into home buying years, this big move up, is a much larger demographic, and the Gen Z is a much larger demographic, and the Gen X is almost the same demographic size as the baby boomers. So if you were to look at all of these, much larger demographic is coming into home buying years than what we've ever had before. So I suspect where we are with the housing market and having no inventory and the millennials coming into home buying years, I see us going far higher in real estate prices before we reach an equilibrium. And that's what's happening now. And if you look at the number of homes for sale nationally has plummeted. This is in 2019. The market was super tight in 2016. And we just continue to go down and down and down. And we have just been on a tear of inventory going down. This has to reverse. You can't have home prices go down with inventory going down at the same time. That doesn't make any sense to me. So all these guys who are talking about this, I don't understand how their viewpoint is until you get inventory back to a respectable level. Someone said this, and I totally agree. It says real estate is a supply-demand game driven by demographics. I love that. As prices outpace wages, prices will fall only if demand also falls. I think demographics will continue to drive demand and prices in the U.S. as millennials now are the largest percent of population and have the lowest ownership percentage. Totally agree with that. I was scrolling through and I read like 30 or 40 replies. I saw this one. I'm like, thank God there's still some sort of logic out there in the world. And there was a few people, but that was probably the best response that I saw. And then I saw this. It says household debt to GDP for United States declining. It had a sharp swoop up in 2020 and it's declining again. So the household debt to GDP for the United States is declining. Then the one person that posted this, they had the U.S. population growth versus the U.S. 10-year bond yield. And they had overlaid this in here. And they were saying that the 10-year yield was going to go lower. I completely disagree with this chart, and I don't think these two are very comparable. That is a U.S. population growth. It all depends on your housing market balance. From 2000 to 2008, we had an imbalance, but we were in a larger, long-term down cycle. And 2020, I think, is the end of that 10-year bond yield crashing lower for a reversal higher. That's my opinion. Looking at Eric Nuttall, I like this one. It says, I don't know who needs to hear this, but the multi-year oil bull market thesis doesn't hinge on war in Ukraine or an Iran deal. And energy stocks have been lagging the recent spike in WTI. Investors need not believe in the calls for 100 plus to still be excited about energy stocks. And this is how many years of free cash flow at $80 strip natural gas price would it take for a company to buy back all of its outstanding shares in debt? Crew Energy CR is only 3.3 years. And they have a lot of potential drilling spots. Athabasca Oil's here, Baytex Energy. There's a whole bunch. Crescent Point Energy that look really good. Looking at this, going back to gold, to the M2 money supply. Gold versus M2 money supply monthly chart. A reverse symmetry move is quite likely, and that also fits timing-wise with my posted dollar gold long cycles charts. And usually what happens, you kind of come in, you get a hump, and then you get in a second one, and then it goes berserk, and then you can draw a line going across. REMX has this same pattern. Copper has the same pattern. There's a whole bunch of other commodities that have this same pattern. Someone posted this. I think it was Tavi Costa 2022 platinum chart, looking absolutely juicy. Platinum usually outperforms in the beginning, outperforms silver, and most of the time gold. It takes a big run, and then it will underperform the other metals towards the end of the bull market. It's a good ratio swap, in my opinion, to be in platinum now and then swap it to silver, because silver is going to go ballistic on the back end of the move, I think. It doesn't mean that I would maybe do all of it, but we'll have to see what happens to the ratio. We'll have to see how high this thing goes and what the charts look like. So that's one that I'm watching. I pulled up another chart here. This is the global mine production. I'm going to focus on this first. Global gold mine production in the gold type bars, and then the gold price annual average. And you can see that the global mine production declined in the 70s the entire time almost, broke into an uptrend in 1980, and the price started to go back down. We had a similar situation from 1999 all the way down to about 2011, and then it broke to the upside right when prices peaked. What's coming is this. It says gold supply forecast industry decline by Barrick Gold. It says the industry is facing a production precipice. Very few companies able to deliver value growth in this environment. Gold supply by region, 2021, and we're declining the entire time all the way out, and they project it past 2029. So if we were to take kind of what happened on all these cycles and overlay kind of the real estate starts and the money coming into the system with declining gold mine production, every single time we've had this alignment, and this could be just by happenstance where we had a large capital, or I should say credit expansion from expansionary phases of real estate, at the same time gold production is declining. We have that same setup right now happening right in front of us. And this is probably a far greater decline. This is talking about 110 million ounces all the way down to 65 million ounces. The declines here were in metric tons, 2.5 to 2.2 metric tons. I think the declines here aren't as great as this, which is projected. So I think that everything that I can look at, guys, everything looks ultra bullish in commodities. The demand supply imbalances in oil, in uranium, in gold, in silver, in platinum, just go on. It doesn't even matter what commodity. They're all jacked up. Copper, lithium, cobalt, nickel, go on and on and on. They're all messed up, all over the place. You could probably throw darts and make money at most of these commodities and probably do pretty well, so long that you just stick with it. So I'm a buy and holder. I think over the next 10 years, we're going to see some massive moves. The liquidity's there from the real estate market, so everything is a go. If you were to randomly look at charts technical charts, I am seeing just massive patterns everywhere on all these different charts of commodities. So, and we're getting the commodity to stock ratio breakout. Stocks are looking quite weak. We're seeing interest rates start to move up. This is right here at the beginning, guys. This is going to be very fun commodity bull market. And hopefully you guys have the patience, have the knowledge to hold on through it. I'm excited for it. I've got a lot of my picks already loaded up. I'm very excited for what's coming, and hopefully we make a lot of money on this. I'm already up a lot, and hopefully it continues. I'm fingers crossed, and hopefully you guys are. I know recently we haven't seen large moves. We've kind of seen we'll call it our first pullback in some of these commodities like uranium. Oil's done quite well. The energy service companies have done very well recently. I think we're going to see another leg higher in something like copper, rare earth metals. I think the fertilizer companies will continue to do very well. I think we're going to see gold and silver firm up. I think platinum should do well. I'm showing you guys all the charts. All the data looks really good. Don't get discouraged. Don't get impatient. Just ride these things out. Let them make you money. Sitting on your hands and doing nothing is going to make you money here. It's going to make you a lot of money. So be patient, guys. Give me a thumbs up for the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.